While many nations are concerned about the next financial crisis, Mexico stands out as an exceptional performer, consistently exceeding expectations with its strong economic growth. In 2023, the Mexican economy grew by 3.2%, maintaining a growth rate above 3% for the third consecutive year. This impressive growth comes at a time the world's most advanced economies only growing 1.6% last year. Mexico's sustained growth is driven by several factors, including strategic geographical advantages and active participation in global trade through comprehensive agreements, bolstered by substantial foreign investment. All this means that Mexico is finally getting rich. So, what's led to this change in fortunes? And is Mexico becoming an economic heavyweight? Today we'll answer these questions and many more, so hit that like button and let's dive in. A key factor contributing to Mexico's economic success is its strategic position next to the United States. The two nations share a 1,954-mile border, which has enabled significant trade and investment exchanges, making them key economic partners. In 2004, total trade between the US and Mexico stood at $267 billion. Fast forward 20 years and total trade has increased 200% to $799 billion, highlighting their deep economic ties and making Mexico the US #1 trading partner. American companies are increasingly looking to Mexico to locate their production facilities, drawn by lower labor costs while remaining close to their primary market. This shift is known as nearshoring, a strategy where businesses move their operations closer to their customers in order to reduce costs and improve logistics. Nearshoring to Mexico has accelerated in recent years as global geopolitical tensions have disrupted supply chains and led to higher transportation costs. Mexico's close location, low labor costs, and strong trade agreements like the United States-Mexico-Canada Agreement, or USMCA, make it a very attractive location for US multinationals, allowing better control over their supply chains and speeding up delivery times. China once played the role of the world's factory, operating as a crucial manufacturing hub for many US multinationals. However, its recent tariff war with the US has reduced US imports of Chinese goods and highlighted Mexico as a much more appealing location for US corporations. Nearshoring has had a big impact on Mexico's economy, especially in manufacturing, creating significant foreign direct investment, or FDI. In the last 10 years, Mexico's FDI has increased 114% from $18.2 billion in 2012 to over $39 billion in 2022. Mexico's automotive industry received the highest portion of this, as US auto companies rely heavily on parts produced in Mexican maquiladoras, which are foreign-owned factories with preferential tariff programs for import of raw materials and export of finished goods. Other sectors like electronics and communications equipment have also benefited significantly from nearshoring. This trend is expected to continue and is estimated to increase Mexico's GDP by an additional 3% over the next 5 years. Nearshoring has also created many jobs in Mexico. The demand for skilled labor has grown, leading to higher employment rates in industrial areas like Monterrey, Guadalajara, and Mexico City. This job growth has improved living standards and boosted local economies by increasing consumer spending. Additionally, Mexico has strengthened its role in North American supply chains through major infrastructure enhancements. Cities like Tijuana, Monterrey, and Guadalajara have become vital hubs, attracting significant foreign investment. Mexico's strategic location also favors logistics and distribution operations. Major ports such as Veracruz on the Gulf of Mexico and Manzanillo on the Pacific coast are crucial for moving goods in and out of North America, improving trade efficiency. The presence of US companies extends to the finance, retail, and technology sectors. Significant American investments in these areas have created jobs, introduced advanced technology, and enhanced management skills, contributing to broader economic growth. Economic connections with the US have also allowed Mexican companies access to American financial markets, securing essential funding for expansion and innovation. This financial integration is vital for maintaining Mexico's economic stability. The US is easily Mexico's #1 trading partner, responsible for 78% of Mexico's exports in 2022. For context, Canada is Mexico's next biggest trade partner, accounting for just 2.6% of exports. This close economic relationship with the United States, while extremely beneficial, does leave Mexico exposed to economic shifts in the US. Despite these challenges, the strategic benefits of proximity to the world's largest economy greatly support Mexico's economic base, providing a solid foundation for continued growth and prosperity. Before we assess the other reasons for Mexico's riches, please take a moment to help us out by hitting that subscribe button. It only takes 2 seconds, and each new subscriber is a massive help for the channel. Okay, moving on. In addition to its strategic location, Mexico benefits significantly from its abundant natural resources. Oil is a key part of this, and Mexico has the 11th largest proven oil reserves in the world, with about 7.4 billion barrels. Oil exports are essential for Mexico's economy, bringing in around $35 billion in 2022, with more than 70% of Mexico's oil being purchased by the US. The money from oil supports many economic activities and government projects, as Pemex, a state-owned company, controls the exploration, production, and distribution of oil in Mexico. Oil revenues contribute to the national budget funding social programs and paying for infrastructure projects. However, being heavily dependent on oil is risky for Mexico, leaving it exposed to fluctuations in global oil prices. As a result, the Mexican government aims to diversify the economy and reduce dependence on oil to create a more stable and varied economic landscape. In 1994, the North American Free Trade Agreement, or NAFTA, transformed Mexico's economy. By eliminating tariffs and reducing trade restrictions, the agreement removed trade barriers between Mexico, the US, and Canada. It focused on increasing investment opportunities and boosting competitiveness. As a result, NAFTA sped up Mexico's shift from an agriculture-based economy to one dominated by manufacturing and industry. By 2020, exports of goods and services had risen to account for nearly 40% of Mexico's GDP, showing a significant increase from before NAFTA. This surge was most noticeable in key sectors such as automotive, electronics, and aerospace. The automotive sector, in particular, became very important, with vehicles and auto parts making up a large part of Mexico's exports. This shift towards manufacturing not only changed Mexico's economic activities, but also increased its foreign exchange reserves. These reserves are important because they help protect the country against global economic shocks, ensuring financial stability. By the end of 2022, Mexico's foreign exchange reserves reached around $202 billion, showing the success of its export-led growth strategy. Having such foreign reserves enables Mexico to keep its currency stable and meet its international financial obligations by providing a readily available pool of foreign currencies to pay off foreign debt and interest payments. This financial stability ensures Mexico can maintain its creditworthiness and favorable terms for borrowing, fueling future growth. NAFTA didn't just boost trade numbers. It attracted significant foreign direct investment into Mexico, especially in manufacturing industries along the US-Mexico border. This investment led to job creation, boosted local economies, and facilitated the transfer of technology and expertise. In July 2020, NAFTA was replaced by the USMCA in order to modernize North American trade and improve terms for industries such as automotive manufacturing. The impact of the USMCA on Mexico has been significant. It has strengthened Mexico's trade relationships with both the US and Canada and grown its automotive sector, leading to more investment and job creation in one of the largest automotive industries in the world. Under the terms of the USMCA, 75% of a car's parts must now be from the US, Mexico or Canada, compared to 62.5% under NAFTA. This rule aims to keep car manufacturing centralised within North America, increasing jobs and the money spent on the car industry. Additionally, the USMCA has created growth in other sectors, such as agriculture, which has seen increased US access to Mexican markets for products like dairy and poultry. The agreement's rules on digital trade and intellectual property have also made cross-border digital transactions easier, benefiting sectors like e-commerce and technology and shaping Mexico's economic future. To keep up with this pace of change, Mexico is working hard to improve its workforce and education system. The government has introduced important policies to formalize employment, aiming to reduce the large informal labor market that currently exists in Mexico. These changes include labor reforms to strengthen workers' rights and improve working conditions. And as a result, formal employment rates have increased, creating a more secure and regulated work environment. The government is also focusing on education and vocational training by investing heavily in educational infrastructure. This effort aims to increase literacy rates and improve skill levels across the population, helping the workforce meet modern market demands. International organizations support these efforts, helping to design educational programs that fit global market needs. However, there are still challenges that affect Mexico's workforce productivity. A mismatch between education and industries in certain parts of the country represent a significant obstacle for growth. Despite this, success stories like Guadalajara's growing tech industry show the positive impact of aligning education with industry needs. To spread these benefits more widely, improvements in rural education and continuous skill development are essential. Another reason for Mexico's growth is its expansion beyond North American trade. Chinese investment in Mexico has increased significantly in recent years, fueled in part by the US-China tariff war. This situation has made Mexico a strategic location for Chinese companies to access the US market without tariffs. As a result, Chinese investment has grown in key sectors such as manufacturing, electronics, and infrastructure development. For instance, Hisense has invested $260 million in a refrigerator manufacturing plant within the Hofusen Industrial Park near Monterrey. This park, converted from a 2,100-acre ranch, currently hosts manufacturing plants for 10 Chinese companies and is expected to grow significantly. Lingong Machinery Group is another notable example, investing $5 billion to expand production in Nuevo León, highlighting the substantial financial commitment Chinese firms are making in the region. The automotive sector also sees significant Chinese investment. Omoda, a Chinese car manufacturer, has launched 2 vehicle models in Mexico and plans to expand its distribution network aggressively across the country. The general trend shows that about 10 Chinese companies are seeking to establish themselves in Mexico per month, with a focus on the automotive industry. This movement is partly driven by the advantageous terms of the USMCA trade agreement, facilitating easier access to North American markets. The benefits of Chinese investment include increased economic activity, job creation, and technological advancement in Mexico's industrial sectors. Despite these advantages, Mexico needs to balance these benefits with the need to develop its own industries and maintain economic independence. Dependence on foreign investment could make Mexico's economy vulnerable to geopolitical tensions, so finding a balance between attracting foreign investment while maintaining economic independence will be essential for Mexico's long-term growth and national economic sovereignty. Looking to the future, Mexico's economy is in a strong position for growth in various sectors as it looks to truly become a global economic heavyweight. If you want to learn more about global economic affairs, head on over to this video where we cover just that. Thanks for watching and see you in the next video.